Good evening, everyone. This is Henry Gambell with simpleroptions.com, and in today's free video I wanted to share a couple of ways that we can look at playing Disney into the monthly expiration. I felt that Disney was a good example of a expiration style trade for several reasons, so let's go ahead and discuss those. One of the first things that I think you want to point out with Disney is the thing that anybody that runs fib work would have told you. The first thing is this was coming down into this area of support, mainly because it was such a large swing. So if you take the low that we put in here on August 24th and run that up to the clear and obvious, major high that was made several weeks after that, the 618 retracement of this move came in at 101.71, and it's the first area that most fib analysts would have told you this is an important area to look to for support. Well, since it's broken, obviously it's not an area that we can really point to any longer. However, the bullish trend will still have one last area that I would give it for hope against this 96.56. All I'm pointing out is that there is a small level of support that you could vouch for, but it is definitely breaking down. Then you take that and think about how far are you from your 21 EMA. This is an area that you tend to see markets revert to. And generally speaking, a good area to think about, if you want to take a trade, be it bullish or bearish, making that decision at the 21 EMA is usually a good point to do it. So I'm thinking in the back of my mind, even though it is kind of breaking down, it could absolutely retrace back up here into 105. Ultimately, you're left with very difficult technical decisions, and it all comes back to the idea that you do not have to have perfect technical setups to trade options around expiration. We go through the basic technicals that I like to look at to ultimately point out this is a very mixed chart. When it's mixed technically, what can you come in and find valuable inside the option chain? In this case, if you drop down into the January 16s, these are the contracts that will expire this Friday and have 4 days of life left. The thing that stands out to me the most is that you have some very standout open interest here on the $100 calls. So what this tells me is that whoever sold these has a vested interest in Disney staying below 100. Well, then if you flip that type of thought process and then come over and look at the $100 puts, here you'll notice you have 21,000 opened. So that is leaning maybe a little bit more towards the idea that whoever sold those puts has a vested interest in those expiring worthless. Well, when you have these mixed forces coming into play, what does that ultimately end you with? It ends with the idea that the stock could trade very close to 100 to try and suck the premium out of both sides of these options. Okay, so once we get through that, how do we start setting up the trade? The three things that I would look at in most of these situations, now Disney's not going to apply perfect to it, but just giving you a couple ideas how to play it. The first one I will look to is to sell a deep and wide 1 month, and it'll actually be a couple more strikes. I like to try and sell these $3 wide, and then taking $1 credit if at all possible. Yes, this is selling this a bit in the money, but if we're going to look for those $100 puts to expire worthless, and we could get $1 for that, I think it's a fine way to play it. Another way of looking at doing this is to buy a call side butterfly. I use very similar logic here, where I'm going to start out pricing it $3 wide, and try to buy it somewhere near $1. If I can buy it in the lower third of the width of these strikes, that allows me to try to sell it somewhere within the range that is 2/3, and that is the way that I like to manage those butterflies. So that is one way to play it to the upside as well. And then one other strategy that doesn't quite fit into what I would like to see here, but we're going to talk about some in the premium video with Amazon and a few others. But if you can take in a credit on an unbalanced butterfly, I think that is also a very interesting strategy to use at this time and point, because you're faced with a situation, and I'm going to illustrate this here real quick. And of course, this right here, as I'm pricing it, is going as a debit, which I'm not really as big of a fan of. But we're facing a situation where several of these markets have sold off hard. We're looking at the idea that they could bounce. However, we could also trade sideways or flush. Now, with this type of a strategy, the flush is what you have to be careful about. So, like I said, we'll talk about that more in the premium video, but if you can do a strategy like this on Amazon or anything else that revolves around a key psychological strike, then what you're going to be able to do is really do well if the underlying trade sideways and pins, and then if we do get this short covering rally and things burst to the upside, that initial credit you took in will still go into your account. So I don't like those as much for a debit in this environment, But with expiration and the chance of a short covering rally, I think playing them for a credit makes a lot of sense. So those are 3 of the strategies that I will be using as we move into the monthly expiration. And then I also wanted to make you guys aware of the class that Bruce will be offering on diagonals. This class will be on Wednesday, January the 13th. That part of it will be in the evening, and then the live trading will be the very next day while the markets are open. So I've learned a lot from Bruce. He has a great way of applying these strategies in all kinds of situations, and I think you will find it very helpful. So there's the information if you would like to get set up. Give you plenty of things to focus on as we trade into the January expiration, and I will see you guys at the next free video.